Following up on our report last week on outsized derivatives, futures, and options leverage use in keeping gold spot prices and gold bullion values polite for paper markets the last few decades. Today in Singapore, Juerg Kiener was interviewed basically saying the world has near to no base metal inventory levels to meet increasing supply demand ahead. Being in Asia, he likely knows that China has pretty much bought up many once more easily available commodity inventory levels. In the 6-minute interview I subtitled here for you, Juerg also drops a hardly known bombshell for viewers live on Bloomberg Asia, mentioning how outsized silver futures and options leverage in the hundreds of paper ounces versus 1 ounce physical supply to the global markets helps maintain the illusion that all is calm in the silver market. It's not. And he describes in further details about silver supply side pressures building at the moment. Gold bullion at these spot price levels, according to Kiener, is also the bargain of the century. Have perhaps a few viewings of this interview and see why the metals markets are his major concern at the moment.
I'm just wondering, if you take a look at the commodities universe, what's the overriding factor that's influencing all the movement? Is it supply chain disruptions as a result of the war in Ukraine?
I think we have a toxic mix of various components which are driving now this universe. One is a huge derivative market, which is actually trading right now currencies and derivatives on whatever news you have. And that market is so big, it's overcasting almost whatever happens on the ground. So if you look at the ground structure, what we really have is an economic structure which is still in semi-lockdowns. So our demand is actually not at its best. I think once we reopen fully the economy, my demand will come back. So what do we have on the supply side? We have disruptions through logistics areas, and we see in many areas that actually shipping has been down. Even BHP reported much lower shipping into China. And despite that, actually we had pretty firm commodities. And the question is why? I think the main issue is actually that my global inventory levels are pretty much at rock bottom. I've never seen them as low in 20 years. And that's putting now significant pressure in an environment where your end user, your industrial side, doesn't want to depend anymore on the warehouses. They want to have offtake straight from the miner or from the refiner. So the whole supply chain is actually changing in an environment where we have no inventories. And to a large extent, even real problems in production. If I look at the quarterly numbers, almost everybody struggles actually to meet their production targets due to COVID.
When you talk about supply chain disruptions and shortages, it's most apparent when it comes to oil. Hence, we're seeing where oil prices are right now. What assumptions are you making? Where's oil headed? We have Morgan Stanley raising its forecast by $10.
Look, I think you can pick the numbers, right? You can say we go back down to 80, or you can say we go up to 200. I don't really know. It's a highly market which is dependent really on sanctions to a large extent right now, which is making it even tougher. I think as long as the war basically keeps going, and the way we actually right now try not to find a solution to the war, we can actually expect that we are rather going to have another move upwards down the road. But looking at particular metals, I look at markets which are even more tight than actually energy. And I'm much more worried about some of the metals actually.
Which ones in particular?
Almost the whole commodity metals market is in backwardation. But if you look right now at zinc, we have zinc smelters shutting down in a time where we are actually really already short and inventories are at the bottom. Now, what's the biggest byproduct on zinc? Is silver. Where do we need silver? Military hardware, technology. Your new form of going green depends on silver. And basically we are now in an environment where we are shutting basically the silver supply down, and on the derivative side we have a leverage of 100, 200 times on the exchanges, and we can't deliver goods anymore. So how are you going to price basically a product in that type of environment? And I think the answer is we see now people going physical instead of paper, and that questions now actually the contract of the paper contract.
And so are you saying that price premium from the Ukraine war, the supply disruptions, that's likely going to stay, or do you think investor demand will start to wane once we get a clearer picture from the Fed later on this year?
Look, the investor demand is is playing to a large extent right now paper. And that's basically, you have a strong dollar, you are short metals. But industrial structure is very different. They don't really care about the dollar, they care about what they have to produce. And that demand is actually getting stronger and stronger at a time where we have actually no supply. So I think on the end, it's the real world which is going to drive the price and not the paper. And I think as a result, from that point of view, we're going to see huge pressure on things like the LME. You've already seen the nickel market actually blowing up. And even by squaring contracts because we can't deliver, it doesn't change your back-end structure on deliverable metals.
Yeah. So you're, out of all the metals that you cover, which is the lowest risk to you?
I think almost everything which goes into the green revolution is actually really in high demand because government policies wants to make us super green. And unfortunately, we're creating a policy without having invested the money to create all the goods we need. And that actually drives prices higher. So you can look electrification, copper is a fantastic environment to be in. You have basically production falling and demand going up. Silver already mentioned, but you can look at the nickel market, another critical mineral in going green, is in very short supply. And if you look at metals in high quality, which have a very small footprint, so which are environmental friendly, then the number is even collapsing to a lower level. You take Russia out of the goods, and you're in a real mess.
Quickly, your gold at current prices, what is it factoring in? A soft landing, a hard landing? Can you read anything into it?
Gold is the bargain of the century, because basically Mr. Putin told you that the price level of support is 1920. So 1920 is actually right now about the bottom of gold at the time where actually a safe haven demand should actually be picking up. So we see a lot of paper market interventions on the gold market. We see rates basically on the ETFs for delivery. And we see supply chain disruptions. So if you look at gold, silver, they are in backwardation. Your delivery time for large quantities is exponential. And the story that there's going to be Russian gold come to the market is absolutely hubris. There's hardly anything coming to the market because basically it goes straight away into the treasury of the BRIC countries.
Kiener is also on record stating that five-figure gold price stabilization will be needed in a new currency realignment to help stabilize the world economy. In this week's show notes below, you can find backlinks to those points. Hello there, on behalf of SDBullion.com, this is James Anderson with a quick SD Bullion market update. Before we go further, please smash the like button so other sound money stackers can also see this content. And be sure to subscribe to our SD Bullion channel so you can get our latest market coverages and also a chance at winning incredible bullion giveaways like this one.
When you love silver as much as me, it's really easy to get carried away. Sometimes I just can't keep my hands off of a good deal. So when SD Bullion told me that they wanted to give away some silver for free, I was happy to lend my voice for the cause. Now how much silver are they giving away, you ask? Boom! Yes! 500 brand new Silver Eagle coins will be going to one of you. Just click the link below and enter for your chance to be the next big winner. Yep, okay, got it.
Click the link below to enter our new 500-ounce American Silver Eagle coin Type 2 giveaway contest. And good luck to all of you who take part. Silver and gold spot price markets both got hammered downwards in this week's trading action. The spot silver market closed just above 24 an ounce, with gold finishing just above 1,930 an ounce. The gold-silver ratio has climbed back up to 80. The platinum spot price market also sold off strongly today, finishing near recent technical support levels around 930. So we appear to have a good weekend to be bullion buying at heavy discounts versus somewhat recent spot price levels. Thus far in 2022, the U.S. bond market has had its worst performance to begin a year, even worse than 1980, back when price inflation was as bad as it is in real terms today. The borrowing costs for 30-year fixed-rate mortgages in the United States have risen extremely fast since the start of the year, now at over 5% levels. And that's the fastest 30-year mortgage rates have climbed since the late 1980s. And the last time we had house buying borrowing costs this high median or middle-priced U.S. homes were more than half of what they are currently now, back in the early 2010s. For a longer-term perspective on true value, especially now living under a secular inflationary regime, it currently costs about 187 ounces of gold bullion equivalent for a median-priced U.S. home. Back in 2011, that number dipped below 100 ounces. And in 1980, when price inflation was about as high as it is now, median price U.S. homes dipped below 80 ounces of gold bullion equivalent for most of that year. In today's fiat U.S. dollars, that would be a gold price near $5,000 per troy ounce to get a median price home. In yet another sign of the changing currency regime times, the nation of Israel announced that it will be adding 4 new fiat currencies to its FX holdings in this year, 2022, adding the recently sharply devaluing fiat Japanese yen, Australian dollar, Canadian dollar, and fiat Chinese yuan renminbi to its basket of FX reserves moving forward. Here you can see the targeted allocations, shrinking the amounts of fiat euros and fiat Federal Reserve notes the Bank of Israel will hold. The Silver Institute, an industry data tracker, made headlines this week with their latest 2021 silver market data, citing a silver market deficit of over 51 million ounces last year, deficits not seen since 2015, and the silver market's most significant size deficit since the year 2010. And not surprisingly, coming off the 2020 lockdowns, silver industrial demand saw increases in every use case. Silver investment demand for physical bullion bars, coins, and rounds came in at a very high figure, with over 278 million ounces bought by physical silver investors last year alone. Breaking down where physical silver bullion buying happened, it was mostly a Western world-driven phenomenon, as Indian silver demand is still waning from where it was typically in the early 2010s. And given how much record gold bullion coin buying is happening still in Australia and in the USA, for instance, we are still apparently nowhere near the moment when the gold price gets so exorbitantly expensive that bullion buyers switch their preference to silver, which often comes near silver price peaks. Turning back to the Silver Institute's silver market data provided by London-based consultancy Metals Focus, I'd like to take a moment to point out one of the most questionable assumptions they make in their 2022 forecast. During the kickoff of the ongoing Reddit silver squeeze movement in 2020, we saw a net inflow of over 330 million ounce equivalent into unsecured silver ETFs or ETPs, exchange traded products. Silver funds like SLV, SIVR, and PSLV saw massive fund flows into them for the year. Now, for the year 2022, Metals Focus makes the paltry forecast of a net 25 million ounces of silver fund flow equivalent moving into silver ETFs collectively for this entire year. Now, just a quick gander at the largest unsecured ETF, which is underperforming silver bullion per usual, the iShares SLV fund already has over 50 million ounce equivalent flow into it to date in 2022. So I and others in our industry find that forecasted figure a bit dubious at the moment. And finally, to finish this week's update, hammering home the point that Juerg Kiener made in his Bloomberg Asia interview in Singapore earlier today, here we have total turnover for major silver futures exchanges in 2021. We had well over 325 billion ounce equivalent futures and options traded to help discover silver's day-to-day spot price in a global market that barely eked out just over 1 billion new physical troy ounces for the entire year. Yet fundamentally speaking, on behalf of the world silver market, current trends say derivative leverage cannot forever mask that the real world is likely headed to acute physical shortages where increasing physical demand overrides limited available silver bullion supplies. It's likely going to require an acutely higher silver spot price in the future to get this market to sustainable equilibrium where demand and supply find a fair value. Priced still below half its all-time price high, silver still seems perhaps the most prudent long-term buy and hold at these current spot price levels in the precious metals and greater commodity complex. That's all for this week's SD Bullion Market Update. As always, to you out there, take great care of yourselves, those you love. If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content.